Hello everyone. Today we discuss about capital intensive, its definition, advantages and disadvantages. So capital intensive is the processes or industries that need enormous capital investments in plants, tools, machinery, etc. to create products or services in high volumes and keep up with optimum levels of net revenues and ROIs. Such organizations have a higher extent of fixed assets in comparison to the total assets or resources. Capital intensive can also be understood as the limit of the business organization estimated in light of capital invest by the business in its plant, tools, machinery, and other fixed assets for optimizing the production that outcomes in the earnings of the greater and profits. The examples of capital investments or capital intensive industries incorporate a car company, gas and oil production, real estate, manufacturing firms, metals, mining, etc. Now, what is capital intensive? We discuss about this. The definition of it. Capital intensive is a defined as the industries or processes or projects that require a high percentage of investments in fixed assets such as fixed capital, machinery or plan to produce a good or services. Capital intensive projects have a high percentage of fixed resources, that is PP&E, that is property, plant and equipment. Businesses functioning in capital intensive industries enterprises are commonly marked by significant degrees of depreciation or devaluation. Now, in simple words, it is a production process that requires a high level of investment in fixed resources, that is machine, capital and plant to deliver. Such as production process will have a moderately low proportions of labor input and will have higher labor productivity also. So it will more often than not have a high ratio of fixed cost to variable cost. Accordingly, the production process might have economy of scale. Now, understanding capital intensive, we all know that all kinds of businesses need funding or capital to run and manage the businesses. But a capital intensive business is estimated in light of the capital invested by it in buying the fixed assets. It is characterized as the capital or capacity of the business or company to put investments into fixed assets or resources. The use of higher investments promotes better ROIs that brings about more financial backers and ultimately optimize the market share also. A few organizations that are capital intensive need higher capital to channel their business operations, which implies that the maintenance cost is additionally high in such ventures. These organizations have higher operating leverage as working expenses becomes higher because of the high investments in fixed resources that are PP&E. However, such industries also have a bigger volume of sales. These industries stands in the market due to the services they give, labor efficiency, maintenance of the assets, risk factors, productivity and many other factors. So to put in plainly, in case the capital expenditure is substantially more than the labor expenditure, then the business would be capital intensive. Now, the importance of capital intensity. Capital intensive businesses will quite often have higher degree of operating leverage that can be understood as the ratio of fixed cost of variable cost. So therefore such industries need an optimized volume to production to give a sufficient ROI. So it additionally implies that little changes in sales can promote huge changes in profits and return on invested capital. Now, hence, having higher operating leverage makes capital intensive industries more vulnerable to financial slowdown compared to labor intensive businesses or organizations, since they need to pay fixed costs like overhead on the plants. Such type of cost have to be paid in any event, no matter industry is going through a recession or not. Some of the reasons behind the importance of capital intensive industries that I'm mentioning right now. First of all, labor productivity. The higher investments in capital increase labor productivity. Capital intensity as well as labor productivity are crucial in deciding economic growth in the long run. The capital intensive methods can be key reasons behind optimized output and everyday comforts. Number two, investment. The promotion of a capital intensive industry also requires a huge interest in fixed resources. Such sorts of uh, high investments requires adequate reserve funds or savings or the ability of firms for financing the investments. Number three, skilled labor. The capital intensity for the most part demands a highly skilled workforce. With optimized capital intensity, there come laborers who work with the machine with adequate abilities and skill sets also. Number four, new trade theory. As per the theory, production concentrates on specific areas. Frequently, the specializations takes place because nations were quick to produce and profited from their capital intensity. Now, measuring capital intensity. Other than the operating leverage, the capital intensity of an organization can be measured through the calculation of the number of assets required for producing a dollar of sales. That will be total assets divided by the sales taking place. This is the opposite of the assets turnover ratio, which is also a sign of the effectiveness with which an organization is using its assets and resources for producing ROIs. Now, hence the measure capital intensity, you should compare capital and labor cost. So generally, capital intensive firms have high depreciation cost as well as operating leverage. Now, in all, the capital intensity ratio is total assets by sale. Now, impact of capital intensity on earnings. When it comes to capital intensive firms, it is important to understand they utilize a great deal of financial leverage, as they can involve plant and equipment as the collateral in any case. So, having high operating leverage as well as financial leverage might be very risky in letting deals fall surprisingly. So, such industries also have high depreciation cost. Experts involved in covering capital intensive industries regularly add devaluations or depreciation back to net income utilizing a metric called EBITDA that includes earning before interest, tax, depreciation, and amortizations with the help of EBITDA. It will become simpler to compare the performance of companies in the same industry. In addition to these, the following are some of the major positive effects of high capital intensive. Number one, it assists in increasing labor productivity and production capacity also. Number two, optimized capital intensity prompts long term economic growth. Increased capital intensity also develops the market standing and growth in market share. Number four, capital intensity is also responsible for prompting the introductions of new technology because unless there is new and efficient innovations, no company will be able to invest in the asset. So, does capital intensive production cost jobs? So, boosted capital intensity can be a reason behind the job of a few workers since there will not be generally required after the advancements. These can prompt structural joblessness temporarily and nonetheless the growth of more capital intensive industries create new type of jobs opportunities like jobs in AI, software design, marketing, etc. So additionally such industries can prompt lower cost and higher wages that cause an optimized interest for a more assortment of services. Now, the examples of capital intensive. Some of the common examples of such industries can be transportations sectors such as airways, railways, waterways that need loads of investments in purchasing the transportations medium or creating the transportation medium. Profits of such industries rely on operational expenses. This means higher operation expenses like labor cost, repair, maintenance, admin expenses, salaries, etc. will ensure lower profits. Profits may also get reduced due to higher depreciation cost. Now, in case you are a utility service provider who wants to set up a plant for offering electricity, then for this you will be required to build either wind, coal, or nuclear power station. So after doing this, you will be supposed to set up a transmission sector along with the retail sector and billing. For all the such requirements, there will billion of USD dollars needed as upfront cost that will be included as asset in the balance sheet of the company. Now, if you are a software supplier, you will be supposed to make programming products and sell them for a profit. For this case, there will be no direct upfront cost and you will just need to hire engineers and hence the main upfront expenses will be their compensations or salaries. Now, capital intensive versus labor intensive. Capital intensive is associated with the amount of capital investment or invested to build the income and profit, while labor intensive talks to the amount of money spent on training to work in order to optimize their efficiency of work, which will bring about optimized productions. So capital intensive prompts an increment in operating and other upkeep cost, while labor intensive prompts deal ideal use of labor resources which lessens the production cost. Capital intensive businesses need a huge amount of money, while to be labor intensive businesses demand an effective and enthusiastic labor force. Now, advantages of capital intensive. Some of the upsides of capital intensive processes are: number one, such businesses have less competition in light of the great capital necessity. Financial backers or investors are more pulled into capital intensive ventures as a result of better ROIs. Investments of capital intensive business significantly comprise investments in fixed assets, essentially plant and machinery, that is considered as safe in comparisons to the other sort of investment, as the businesses can appropriately use the assets to acquire the profits. Now, the non-operating expense such as depreciation is high in capital intensive, that gives the advantage in the tax payment, as high depreciation offer low profit and consequently low tax also. Now, disadvantages of the capital intensive. Some of the notable downside of capital intensive companies. Number one, such companies have a high risk because of the huge investment. At first, the misfortunates or misfortunes or the losses will be more because of huge investments as well as the depreciation. The liquidity stays low in such businesses as 60 plus percentage of resources or assets generally comprise capital assets. And maintenance cost is such organizations are quite high, as the fixed assets and machinery requires consistent maintenance. Now, what's the conclusion? While winding up this post, there is clear that capital intensive refers to those businesses or companies that invest more and in capital resources or assets in general, and 70 to 80% of total assets comprise fixed assets, machinery and plant. Such industries requires heaps of money for industry survival. In such businesses or industries, the operating and maintenance cost will also be more, as the assets need constant servicing and maintenance. However, such businesses save the tax, as the devaluations or depreciation and other expenses are higher, which brings about lower ROIs. So these businesses or companies suffer misfortunes or losses at first, yet over the long run, these companies or businesses acquire higher profits. In such industries, long run growth is considered good, but the gamble or risk included in such industries is additionally higher. Thus, the competition is impressively low. So, while deciding whether a business or company should go for capital intensive setup or not, a few reasons or decisions go in the process. And in some of the organizations, being initial capital intensive is mandatory, like power utilities, automobiles, while there are other businesses where being high capital intensive is a choice, such as software, streaming, etc. So, all in all, analyzing the power that a company has and the capacity it has to keep the market share will help in understanding how capital intensive a business or project ought to be. How effective and profitable do you consider capital intensive companies and demand large amount of investments? So that's the end of the video, my friends. If you like my video, please subscribe, like, share, comment on my video. Thanks a lot for watching.